This is the Missouri Low-Income Housing Tax Credit explained in under 4 minutes. This is Sean. Sean lives in a rural community in Missouri and has noticed his area is lacking in affordable housing for the aging and veteran population. Fair market rents are too high and out of reach for this population, and the citizens attempting to live in fair market rent prices are quickly exhausting all resources to stay in a safe place. Once all their assets are gone, they're living in their cars or they become homeless. There is plenty of land in his community to build housing units, but who would want to build an apartment building where they have to charge less rent than it costs them to build and finance? He starts researching solutions and comes across a program called the Low-Income Housing Tax Credit. Sean learns that the Low-Income Housing Tax Credit is issued by the Missouri Housing Development Commission, or MHDC, and the credit's purpose is to offset some of the project's construction costs so that rent can be reduced to an affordable rate for those who qualify, like seniors and disabled veterans. Basically, the state of Missouri has said, hey private sector, if you build, maintain, and occupy affordable housing for our elderly citizens, our citizens with disabilities, our veterans, and our families struggling to get by on low wages, we will reduce your tax burden. However, in your application to receive these credits, you will need to prove that you have all the capital required to finish the entire project. Oh, and you have to prove via population study that your area truly has a need, and that you maintain that commitment for 30 years. 30 years? Yep, 30 years. Sean knows he doesn't have all the money needed to complete a project in his area, so Sean looks for an investor. This investor can be a bank, an individual, or a business. Sean knows that the investor will not recoup their investment for nearly 14 years, therefore has to discount the credit for the time value of money and the risk the investor incurs. But this is still far less expensive to the state with zero risk than if the state attempted to fund 100% of the project's costs and then maintain that project as well. Sean also finds a construction team and receives a quote for his low-income housing project. Now it is time for Sean to plead his case to MHDC, which is a very competitive application process, but great news, he's awarded the credits. Sean turns around and sells those credits to his investor. He then receives the capital he needs to build his project. His investor is keeping a close eye on Sean and the construction team because she can't start cashing in her tax credits until the project is completed and the units are occupied. Sean works tirelessly and finishes the project. Unfortunately, not everyone in need of housing can fit in this development, but at least it's a start to improving the lives of the citizens in his community. The units fill up quickly, and the investor can start redeeming her tax credits over 10 years. Each time she tries to cash in, MHDC makes sure the units are still in high quality and completely compliant with the strict guidelines issued for the project. If an inspector finds an issue as minor as a screen door torn or a lawn not being kept up to standards, the investor can't redeem her credits until Sean fixes those issues. Sean and his investor form a wonderful working relationship, and since they did such a great job in the eyes of MHDC, they will be able to apply for more projects in hopes of one day having affordable housing for all. Yay!